Hello viewers, good to have you today on this channel. At this session, we shall be looking at likely GCE economics questions. Please settle down and let's trash it together. Which of the following best describes the basic economic problem? How to increase export, how to allocate scarce resources among unlimited ones, how to reduce unemployment only, how to fix a budget deficit. If you have been following this channel, I have made references and emphasis on the fact that the major challenge you have in economies is limited resources chasing after unlimited ones. And that is why we're going to study economics, so as to see how we can manage the limited resources, the available resources, to reach out to the most important, most pressing wants from all our lists. Remember, human wants are unlimited. So the correct answer to this question is option B, how to allocate scarce resources among limited ones. The next question, if the demand for a product decreases and the supply remains constant, what is likely going to happen to equilibrium price and quantity? What is equilibrium price? As you have it like this, this is your demand curve, this is your supply curve, and this point of intersection, that is the equilibrium point, where this place is equilibrium price, and this is equilibrium quantity. All right. So equilibrium price is the price where the seller is ready to sell and the buyer is ready to buy. In other words, the price where quantity supply equals quantity demand. We call it equilibrium. The word equilibrium is equality. Are you with me? Very well. Now, we are saying here, if the demand falls, as the question stated, the implication is that the quantity supply will now be greater than the quantity demanded. In other words, there are more of that particular product in the market, but there are less people to buy. If you're a seller, what will you do? The only thing you do is to try to reduce the price as a seller. Now, when you reduce the price, the reduction in price will attract the buyer to come and buy more from you. So as the price reduces, the quantity demand will rise. Why? Because of the laws, the two laws of supply and demand. For supply, it says the higher the price, the greater the quantity supply. They are directly proportional, price and supply. While for demand, the law says the higher the price, the lower the quantity demanded. That is inversely proportional. Now, getting this understanding for this analogy, let us now pick our answer. Any answer that is telling us that the price falls and the demand increases is our correct answer. Okay? I'm even expecting that from this place, equilibrium price and quantity. That is where it meets supply and demand. So the correct answer here is price falls, quantity rise. The seller bring down the price so that the buyer can be attracted to buy more. Option D is the correct answer. I hope you are clear. Very well. A country's gross domestic product, GDP, increases, but population grows even faster. Which statement is correct about per capita income? The word per capita income, PCI, is talking about the income per head of the population. That is the GMP or the GDP, whichever one of them, over population. When they divide what a country generates in a year by the total population of that country, what is the income per head of each individual? And that determines the standard of living of the people of that country. Okay. Now, from the question stated that GDP increases, right? But population grows faster. In other words, the population grows faster than the GDP. What do you think will happen? Very well. To the PCI, it must increase. How can PCI increase? Because now, though there's increase in GDP, but the greater increase in population has shortchanged or varied the increase as in GDP. So we'll not have enough to share for each one. Even if there's any increase, it just be a minimum, infinitesimal, but not just be noticed. You understand? It must stay the same way. It cannot. There's always going to be a movement, okay? Whether down or up. It might decrease. It must double. The answer I will pick for this question is that the PCI may likely decrease. Do you know why? Because the population is not greater than the GDP. So that's what is happening in Nigeria today. That's why Nigeria is having a lower PCI. Why? We have a great population of above 200 million. But our GNP or GDP is not commensurate with our population. And the rate of our population growth keeps on going and going and going up. All right? Compared to other countries around us who has what? High PCI. So Nigeria PCI is low income per head. And that's what is affecting our standard of living. And that is what they say. Nigeria is the poverty capital of the world. Okay? So let's move on to the next question. What is meant by opportunity cost? This is one of the major concepts in economics. And I think in our previous videos, I've dealt with this concept over and over again. When we see opportunity cost, we are talking about the foregone alternative. Okay? We are talking about sacrifice for satisfaction. Okay? We are talking about the real costs. The real costs as against money costs. All right? Very well. So, the alternative foregone is opportunity cost. In other words, what you sacrifice to enjoy your choice, to make satisfaction for your choice. That's alternative foregone. So, what is meant? The cost of a missed business opportunity now, the benefit foregone when one alternative is chosen instead of another. C, money spent on investment. D, the fiscals of production. The most correct answer for this question is B, the benefit foregone when one alternative is chosen instead of another. Anytime you hear the concept opportunity cost, please advise you. Let these three statements ring in your head. 1, foregone alternative or alternative foregone. 2, sacrifice for satisfaction. 3, real costs. Okay? What you actually sacrifice to get what you want. Very well. So we'll move on to the next question. If you don't mind. All right. In a perfectly competitive market, each firm is a price maker now. They are giving price. They are price taker. Firms produce differentiated products. There are many firms with free entry and exit. There is only one firm. We say something is competitive and say only one firm. That's monopoly. All right. So the correct answer to this question is there are many firms with free entry and free exit. Option C is correct. Which policy tool is used by the central bank to reduce inflation? Decrease interest rates, increase money supply, sell government security, lower reserve requirement. Now, when there is inflation, inflation simply means when there is general increases in the price level of goods and services. General increases in the price level of goods and services, such that too much money is chasing after limited goods. We're experiencing that in Nigeria right away. Okay, so when there is inflation, in other words, I know when too much money is in circulation, the implication is that money will now start losing its store of value. Why? What your money can buy in July, this is November, it won't be able to buy it again because of what? Inflation. All right? Even your investment, if it's not rising above inflation, it's still more or less a loss along the line. So, what the central bank normally do, and they are doing that right away. In fact, I just got one of the adverts that I'm trying to respond to on this matter. The government sell securities. They sell bonds. Okay? Transfer payment. They sell bonds particularly. Okay? Now, either for short term, for medium term, or for long term. Now, when government is selling to you, the implication is that you are releasing the money in your hand to the government. Thereby, you have less money to spend. So they are indirectly reducing the money in circulation. So as what? To reduce the effect of inflation. So what central bank does is to what? To sell government security. Another policy central bank can use is what they call monetary policy. I think we're going to come across a question like that before the end of this session. And if government itself want to intervene without a central bank, government can also use what we call fiscal policy. These three policies, will come across them in the course of this session. Okay? I hope you're enjoying the class. Please subscribe to the channel and of course share the link with your friends so that they too can benefit from this once in a life opportunity time. What happens when a price floor above equilibrium is imposed on a market? Now, when we say price floor, from the word floor, what is floor? On the ground, below, lowest, lowest, below. So when this is the equilibrium price, like I showed you in the first question we answered today, all right, this is the equilibrium price. So when the price, assuming the price is 10 naira, and the price now falls to 5 naira, from the explanation I gave to you on the law of demand and supply, what do you think will happen? Price has fallen. The implication is that supply will what? Will fall, while demand will what? Will rise. Okay? Now we're talking about what will be the effect on the market. The shortage of the goods arises. The surplus of the goods arises. Supply equals demand, no effect. The answer to this question is that a shortage of the goods arises. Why? Based on the fundamental laws of demand and supply. Are you with me? Very well. Because as the price has fallen, the supply automatically will fall based on the law of supply, while the demand rises. So there will be shortage of that goods in the market. Okay? The correct option there is option A. So let's move on to the next question. Marginal cost refers to, and I think one of our earliest videos too, I did a lot of deep explanation on the word marginal. Okay? The word marginal simply means extra units or extra additional units, extra one added. Okay? So if you have done 100 number of a product and you are doing 101, the cost of producing that extra one is what we call the marginal cost. Are you with me? So which of these options stated this? Total cost divided by output? No. That is talking about average revenue. That is talking about average revenue. That is average revenue per one. Then cost of production, the first unit only. First unit, no. It's not the first unit, but the additional units after the original quantity, the extra one. Additional costs incurred in producing one extra. Can you see what I said? One extra. Okay? Fixed cost plus variable cost. That is total cost. All right? So the answer is C. Additional costs incurred in producing one extra unit. Very well. The next question. Which of the following is not a factor of production? Just by closing your eyes, you can pick this answer. Because we have four factors of production: land, labor, capita, and of course, the entrepreneur. So the only one that is not here is entrepreneur. And what is to replace it was taxation. Taxation is not a factor of production. And the option is what? D. What effect does depreciation of a nation's currency have on its exports, being other things constant? In other words, ceteris paribus. If and only if all other things being equal. So when there's depreciation, as we're experiencing in Nigeria today, of our currency, our naira, in exchange for all international currencies, like dollar, like pounds, like euro, and what have you. So what do you think will be the effect? The effect is export become more expensive, export become more cheaper, no effect on export, export shrink automatically. The answer is export will become more cheaper. Okay? But why this is not working for us in Nigeria is because we have less than nothing to export. How many of our primary or raw material products that can be exported and acceptable in the international community? Assuming we have more than enough, this should have worked for us. This depreciation of our currency should have worked better for us because exporting our products become cheaper. All right? And when export becomes cheaper, the implication is that we are selling more to other countries and we are receiving, we call it receipts. They are paying us, we are receiving more money. And by so doing, our balance of trade will pick up. Okay? So the correct answer here is option B. Very well. The next question. In the short run, aggregate supply, SRAS, COF, if wages increases unexpectedly, all else equal, the SRS will, this all else equal means ceteris paribus, if all other things are equal. When your wage, your salary suddenly increase, what do you think will happen? Naturally, what will happen? You are going to buy, you are going to make more demand, you are going to buy more, your taste will change, your fashion will change, your consumption will change. Are you with me? Very well. Even savings will change, investment will change for some people who has what? Investment mentality. Are you with me? So, what is going to happen? The COF, the short aggregate supply, what happened to supply? We're talking about, so our emphasis on supply, the S, not demand now. So, when your wages increases, I told you the implication is that you want to buy more. Okay? The demand will increase. And once demand increase, the implication is that the supplier will want to meet that demand by also increasing the supply. Okay? So now, you remember, when you talk about shift is saying that even though the price is the same, the quantity demanded, differs for reasons that is beyond price. Not because of price, because price is not changed, but better because of income, because of fashion, because of taste, because of technology, and other factors that will affect demand or supply. So the implication is that since demand has increased, invariably, supply will want to meet up with the increase in demand by increasing supply. So the increase in supply, is it a shift to the right or a shift to the left? In one of our earliest videos today, we did extensive explanation on what they call movement along a supply or demand curve, which look like this. This is what they call movement along a demand curve, up and down, right? Why? We also explain this, which is what shifts in demand or supply curve. This is shift. Shift is either rightwards or leftwards. When you are going rightwards, that is backward. You are going backward towards zero. And when you are going backward towards zero, that is lesser, reduced. But when you are going towards the right, it means what? Increase. You are doing more. And that's why we have something like this for demand. And we have the same thing also for supply. Because the price remains the same, other factors affect supply and demand. And particularly the factor we are talking about here is the income of the consumers. Okay? So if supply shifts to the right to meet up with increase in demand, then there's increase in what? In supply. Option A is, of course, the correct answer. Okay? Now we'll move on to the next question. Which of the following is a normative economy? The word normative means normal. What will happen normally? Okay? That's what it's talking about. Normal situation, normal reactions. All right? Unemployment is currently 8%. Inflation was 5% last year. The government should increase minimum wage to reduce inequality. As price rises, demand falls. Okay? This A, B, and C, they are incomplete statements. You just made it like a clause or a phrase that has no complete meaning. Okay? But from what I said earlier, based on the law of demand, when the price rises, the implication is that the quantity demanded will fall. Meanwhile, quantity supply will rise. Because of the relationship between supply and price is inverse. I mentioned that earlier. While the relation between price and supply is directly proportional. While the relation between demand and price is inversely proportional. As one is going up, the other is coming down. All right? Very well. So let's see what they have for us. The GC question of WAEC in the next question. If the elasticity of demand for a good is minus, that's negative, 0.5, the demand is what? You know that when it is 1, we say it's what? Unitary elastic. When it's greater than 1, we say what? Is elastic. Huh? And when it's much more greater than 1, 2.345, it says what? Perfectly elastic. But when it is less than 1, what do we say? We say that demand is inelastic. And 0.5, or even the negative, is less than 1. Okay? It could also be perfectly inelastic. But here, the correct answer is option C, inelastic. Okay? Very well. Let's see the next question. What is the likely consequence when a monopolist practicing price discrimination divides consumers according to their willingness to pay? There are major concepts you need to understand from this particular question. It's a very technical question. One, a monopolist. Who is a monopolist? Is the only supplier or seller of his product. So you can do whatever you like with his price. And people will still buy because you have no alternative. So you can do what they call price discrimination. You can sell one price in Lagos, another price in Ogun State. All right? And that is what it means. Then you can set the price based on the capacity of the consumers to pay. Very well. So what do you think will happen? Total welfare always decreases. Firms' product increases. Firms' profit increases. C, price remain the same for all consumers. C cannot be correct. Do you know why? Because you say there's price discrimination. So price cannot be the same. Okay? Something you bought in Lagos for 1,000 naira, you could get to Ogun State and buy it for what? 1.2 or 1.5. Because of transport, because of logistics. Okay? And because, or you could also buy it lesser, depending on the standard of living of the people in Ogun State. If you see it's a village, you can bring it down a bit so as to encourage them to buy more. So something at 1,000 could be sold at 900 or 950 so as to encourage people to what? To buy. The market becomes perfectly competitive. No? The correct answer to this question is the firms is likely going to what? Make more profit. The profit will increase. Do you know why? You will go to a place like Lekki. You can sell that thing that costs 1,000 for 5,000. There are plenty, people are very rich, there are plenty of money. If they need, they will still buy. You understand? So the selling of just one product, he has already made his profit for 5. Okay? So that's what happens. So his profit will increase because of that price discrimination is doing based on what? The consumer capacity to pay. Very well. The next question. The law of diminishing returns states that as all states that. So what's the law of diminishing return? Look at the word diminishing. Diminishing means reducing. Returns means what to get. What to get is reducing. Are you there? As all input increase, output increases proportionally. It can't be increasing when it says diminishing. As a variable input is increased, holding others constant, marginal product eventually decreases. It's possible. Let's see the next option. C. Fixed costs eventually become variable costs. Profit diminishes with time. The correct answer to this question is option B. As variable input, as you add more and more inputs, all right, to your productivity, input is increasing, your raw materials, all right, they're increasing. The implication is that if other factors are constant, eventually your marginal product, what you get at the end of the day, the what may decrease. So option B is interpreting the law of diminishing returns. Very well. We see the next question now. Okay. What does fiscal policy refer to? I think I mentioned this a while ago when I was talking about central bank policies to control inflation and government policy to control inflation. Okay. I mentioned the selling of securities like bonds. All right. I mentioned monetary policy. I mentioned fiscal policy. All right. Very well. So what does fiscal policy refer to? Government spending and taxation decision, central bank's interest rate decision, actions of private firms in investment, exchange rate adjustment. The answer here is government spending and taxation. Now, the current government of Nigeria is applying this at the moment. If you notice, that's what they call a new policy on taxation, a tax review that is taken off from January 1st, 2026, such a way that many people will not be able to escape tax as they are doing at the moment. Everything is taxable as long as you have a bank account. And some people are carrying their own money to keep in their houses under their bed. And that may also lead to what? increase in crime rates if people don't go to the bank. But as long as you have a bank, you are going to what? Pay tax. All right? So that's fiscal policy. Talking about government taxation policy and government spending policy. The spending policy could increase, could decrease, depending on the situation of the economy. If there's inflation, government will reduce expenditure and increase tax. The increase in tax is to reduce the available funds in the hand of the people, so they can be able to demand less. And also to reduce total money in circulation, so that the value of money can also improve. All right? This monetary policy, I think we are still going to come across a question that is similar to that. Okay? So let's see the next question. When a country engages in free trade, one of the expected benefits is reduced import, specialization according to comparative advantage, complete self-sufficient, high tariff revenue. The answer here is that, no, at the moment at Lekki side, we have what they call free trade zone. And that is where Dangote built his refineries. I've not been there anyway, though it's not too far from my office. But people that have been there said there are so many Chinese companies and other countries' companies that are operating in that place. Being free trade zones means they pay less or little or none tax to the government, because they have come to help government to develop the area. Okay? By so doing, the implication is that there will be specialization according to comparative advantage. You know, in other words, you start producing the product that you spend less to produce than the other that you spend more. That's what they call comparative advantage in international trade. Okay? So let's see the next question. Which of the following is an externality? Externality means not actually part of the economy, either of the company or of an organization. It's from force outside the company, force outside the organization. A pizza bought by a customer, pollution from a factory affecting nearby resident, a bank loan to a small business, a government bond issue. I think the answer here is pollution from a factory. Okay, the residents, they are suffering pollution, not because they're the owner of the company, not because they are working in the factory, but because the factory is located around their residence. And the pollution generated by the factory is affecting them in their possibly estate or community. So that is an externality, external effects of localization of industries. Option B is the correct answer. If a price ceiling is set below equilibrium and enforced, what happens? I think we have done a question like this before. When you see the price, that is the maximum price, is below equilibrium. Remember what I said earlier? The equilibrium price is the price where seller is ready to sell and buyer is ready to what? To buy. Okay, when you now set it below that equilibrium price, or the ceiling is up. Remember, we have done the one I talk about floor. Floor is below, okay, where ceiling is above equilibrium price. All right, what do you think will happen? In other words, as the price is higher than the price seller is ready to sell, the seller will want to bring more, supply more, so as to sell more. So it's an advantage for the seller. So surplus arises, shortage arises, supply increases at equilibrium, nothing happens. But anyway, as the supply increases, demand also what? Decreases. Okay? So in the price ceiling set by equilibrium and enforced, what happens? The implication is that there will more supply. Or better see, when they see price, the price is below the equilibrium. So also below. Since it's below the equilibrium is the price the seller is ready to sell. That's the price is ready to sell. But you now bring it down less than what you want to sell. So it's going to reduce the supply in the market. So option B is the correct answer. There will be shortage supply in the market. Shortage will arise because you brought the price down. And remember the law of demand. Once the price is down, the supply will be down. Okay? The next question, what is meant by inflation? I think I've explained this today. Abi? Very well. Rise in real GDP, rise in general price level of goods and services, increase in unemployment, increase in the money supply only. The answer is option B. When there's general price increase, in the level of goods and services. The next question, which of the following best describe public good? What is a public good? A public good is a good that is available for everyone to consume, available for all. And the consumption by one person, Mr. A, does not stop Mr. B for consuming the same product. Let me give you a practical example. Air, the air that we breathe. This air is not exclusive to individual, to one person, only the government. All of us have access to it. The fact that government are breathing the air does not stop people to breathe the air. Are you with me? Very well. So air is a practical example of what? A public good. So what do you think will happen? Non-rival, non-exclusivable. Rival and exclusivable. The word non-rival means no competition. It's not, you're not competing for breathing air in and out. Carbon dioxide and oxygen, you're not competing with anybody. And it's not the exclusive right of anybody. It's for all of us. So it is non-exclusivable and it is not rival. Okay? Rival, no. The answer is A. It is non-rival, non-exclusivable, which means one person cannot carry the whole air and keep it to himself. If it's possible, then all of us would have been dead. Because I'm very sure a Nigerian politician will carry the whole air in Nigeria and put inside his own house in the village alone so that people can suffocate and die. You know, that's how greedy they are. That's how they're stealing money. Okay? So the answer is A. Non-rival, non-excludable. No competition for it. And no one can take it. No one can consume it and stop it from consuming yours. What is the main aim of monetary policy? I also mentioned this earlier when I was talking about central bank policy to correct inflation or deflation, to determine tax rates, to control money supply and interest rate, to spend government budget, to run state-owned enterprise. The answer is to control money supply and the interest rate. With monetary policy, the government can decide to increase interest rate on loans so that people will not be able to get more access to more loan. When you look at the moment now, I think the interest rate to get a loan from the banks is about 33 to 35%. So what kind of business are you going to do to get such a loan and pay back and make your own profit? So you'll be reluctant to take that kind of loan. It's another way of what? Reducing the money in circulation. The next question, if the government increase subsidies on production of a good, the supply curve will do what? Now, what do you mean by subsidy? Subsidy is like grants, assistance given by the government to a company. Okay? In other words, as you are producing this particular product, government will subsidize you, either by telling you not to pay tax or pay later tax, or by saying that we're going to supply you with ammunition, machineries, okay, to boost infrastructure so as you can be able to do a better product and more quantity. So when government does that, increase subsidy, the implication is that this producer will be able to produce more of that particular product. So what happened to the supply curve? The supply will shift to where? To the right. Remember I told you earlier that curve, supply shift to the right. Rightward shift means what? Forward shift. That is positive. Forward shift, positive. Supply will shift to the right, increase. The quantity supply for that product will increase. Okay? Very well. The next question. Gross national product, GNP, differs from GDP in that. Now, gross national product, gross domestic product. What domestic? That's within. Okay? Gross national means both within and outside. Okay? That is our national that are outside with their earnings. So what do we say? Includes foreign firms in the domestic country only. Excludes income from abroad. Has net income from abroad to GDP. Is always lower than GDP. GNP will always be higher than what? GDP. The difference between GNP and GDP is the income from abroad, income from outside. So the answer is C, has net income. In other words, GNP equals GDP plus income from abroad. Are you with me? Income from outside. Very well. So the option B is the correct answer. Okay? The next question, the budget deficit is when? You know, we have three types of budgets. We have balanced budget, we have deficit budget, and we have what? Surplus budget. In a surplus budget, we say what? The revenue is greater than what? The expenditure. For deficit, we say revenue is less than what? Expenditure. Which means for you to finance all your expenses, you have to go and get loan, international loan, or local loan. Balanced budget is when revenue equals what? Expenditure. All right? So government can plan any of this budget depending on the situation of the economy per time. Are you with me? Very well. So when there's a deficit, like I said, revenue is less than expenditure. In other words, government is spending more than what they are receiving, which means they're already in debt, borrowing loan. Government revenue exceeds government expenditure. Government expenditure exceeds revenue. Government borrow decreases. Government increases tax. The answer is government expenditure exceeds revenues. I hope you're enjoying the class. Even as you're drawing closer to the end. I hope you're enjoying it. Please subscribe to this channel and also invite your friends. Share the link with your friends. You can also enjoy this very wonderful experience. Which factor is least likely to contribute to long-run economic growth? You know, we have short run and we have long run. Short run is a limited period of time that notice may not be observed in the factors of production. So that's why we say at the short run, all factors of production, land, labor, capital, and entrepreneur, they are fixed. But at the long run, is for all the changes that is inevitable to take place in the cost of production will take place. So at the long run, eventually, all the factors of production may become what? A variable factor, including land itself, because you can move the factory from Ogun State to Lagos. All right? So which one is least likely to contribute to long run? Increased investment in capital goods, technological progress, increased population growth without productive growth, gains, improvement in human capital. When there's human capital improvement, which means it's positive. When there's technological progress, that's positive. When investment increases on capital, what are capital goods? Machineries, that's positive. This is only negative part. See, it said increase in population without productive gain. Population is increasing, but they're not producing enough. What is the essence of increasing population without production? And that is what's happening in Nigeria. Our population increased by the day, but we're not producing enough. Okay? And that's why we have to depend so much on imports to meet up with the shortfall that we're not able to produce locally. In a market economy, in our LS videos, I did extensive discussion on basic economic system, right? Where we talk about the capitalists, the socialists, and of course, the means economy. Okay? So the capitalist is also known as liberal economy, or you call it laissez-faire, or you call it free enterprise. All right? Free enterprise, where individuals control the available resources. All right? Means of production, distribution, and exchange of goods and services. But in social, we call it command economy, public control economy, government regulated economy. Are you with me? These are socialism. What it means is when both the private and the public, both private and public control the economy. So in a mixed economy, what happens? Only the state produces all goods. That's socialist. B, there are no private enterprises. That is socialist. A and B is talking about socialist. B, both private sector and government play roles in production. Yes. The market mechanism is entirely absent. Off. Okay? So the answer is C, because there's presence of price mechanism also, because of the presence of private individual. So option C is the correct answer. The next question, what is meant by terms of trade? The word terms. Terms of trade is talking about the ratio or the rate at which our export is determined by what? X. Exchange for what? For import. Import is determined by what? M. Okay? The rate at which we exchange our export for import. That is what we call terms of trade. The answer is what? Let's see. A, the ratio at which a country's export trade for its import, yes. Trade of times in the economy, no. Ratio of import to export, no. Total, I don't know why this seems to be, it's a subset. C is a subset of A. So the A is the most correct answer because it's more comprehensive and more explanatory. A is correct. What is a consequence of persistent high unemployment? When unemployment persists, people are looking for a job, but they cannot find job to do, like what's happening in Nigeria. What do you think will happen to the economy? Inflation, that's increase in prices of goods and services. Reduced output and idle resources, yes. Higher interest rate, how come? Increase in export, how? When people are not getting job, how can they increase, what do you call it, export? How can it be high inflation? When they don't have job, where would they get money to buy? It is when there's plenty of money that there's inflation. So the correct answer is what? B. The output will reduce because less people are working and many resources will be idle because people that are supposed to make use of these resources are not being engaged. Option B. This is likely going to be our last question for this session. Which type of unemployment is caused by structural changes in the economy, e.g., decline of an industry? Now, from the word structure, structure is talking about when there's a change, particularly from method of production, maybe from labor intensive to what? Capital intensive. Labor intensive is when you are using manpower, laborers, to work for production. The capital intensive is when you engage machineries. When you are engaging machineries, you need less manpower. Because machine can do the work of 10 people. So you only need one person to operate the machine while the machine do the work. So correct answer here from the question structure is structural unemployment. At this point, we'll call it a day today. But I would advise that you subscribe to the channel as well as invite your friends. Share the link with your friends so they can learn what you are learning. And if you have any question or your reaction or your comment, please send it at the link.
Hi, I'm sure you enjoyed the content you just watched. To see more episodes as that, preparing you for your oncoming exams, smash the subscribe button on this channel right now and visit the playlist that we've made for you, covering over 50 type of different exams, including JAMB, WAEC, Cacao,